Right now, our business is a blend between two things. The majority of what we buy is funded with investor capital. We buy these small to mid-sized deals and really a select few very small markets in the Northeast. We're not massively growing year over year in terms of like we bought 100 last year and then we're going to buy 300 this year. Next year, we want to buy 750 or whatever. And there's a couple of reasons for that. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. This week's episode is going to be another feedback slash Q&A episode. And if you're a new listener or if you've missed these episodes in the past and you've been a long-time listener, what we do in these episodes is answer questions that are submitted to me via my Instagram account. So every once in a while, I'll go out on Instagram, post a story. Hey, going to record a feedback episode. What topics do you want me to touch on? What questions do you have? Solicit some questions from our audience, and then I'll actually hop onto an episode here and answer them. So this week, what I'm going to be talking about is some of the quick metrics we use to screen small deals and large deals. So that's 2 to 4 unit deals and 5+ unit deals. Received a question about what our plans are with our business, and more kind of what my personal plans are with the business as it relates to, are we going to get into new markets? Do we want to pursue different types of deals, etc.? And then I'm also going to talk about how we think about using debt versus equity. And I'm going to get into some of my thought processes around, early on, should you raise capital? Should you use a lot of debt? How do you balance the risk reward of both? So I think there's going to be something in here for a lot of folks. And I think this is going to be a great window into how I'm thinking about our business right now, how I thought about it when we started, and talking about how we quickly look at deals. Give this episode a listen. But also, if you don't follow me on Instagram, at Multifamily Wealth, and follow me there so that the next time I post about one of these episodes, you can hop in there and share your thoughts. All right, so this first question that I have here is from Pat, who was wondering, what metrics do you use to identify deals worth buying, both 2 to 4 unit properties and 5+ unit properties, if those metrics are different? So I'll take this a couple ways. High-level screening is very straightforward, and I think it's probably what many of the listeners already do, which is look at total rents versus purchase price on a monthly basis. Bigger Pockets coined that as the 1% rule, but it was a popular rule for a reason, and that's because it does carry some weight and does help you actually screen deals. The other is a quick price per unit, back of the napkin check, and then I'll quickly touch on yield on cost versus market cap rate. But 2 to 4 unit deals are really hard to take a back of the napkin screening approach to, because they're comp based, right? It's not income based. They're valued based on comps, and that can mean an entirely different thing if you're in, this street versus that street, even within a submarket. Bedroom count, the finishes in terms of the kitchen and bathrooms, etc. And also, it's not dependent on rents. Fundamentally, someone is inherently willing to pay a little bit more for a building, even if they want to house hack it, or even if it's a comp-based valuation that the appraiser's taking. There is still some value in units being occupied by tenants who are paying higher rents comparatively to lower rents, but it's fundamentally not how those properties are valued. They're valued based on comparable sales. That said, 2 to 4 unit properties, you should still be taking a quick price per unit approach to looking at deals to see if it's worth your time, right? And this comes with just underwriting a lot of deals in your target market within your acquisition criteria. You should have a sense of what, let's say you're looking for 3 unit deals in your market. You should have a sense of what 3 unit deals trade for on a price per unit basis within a range. So for example, maybe in your market, they trade for between anywhere from 125 a unit to 175 a unit, or whatever the numbers might be. And you know that on the lower ends, those are properties that maybe are in the slightly rougher areas that have lower bedroom counts, maybe predominantly 1-bedroom units or, studios or whatever. 175 a unit, those are maybe not the nicer area, or they have larger bedroom counts, right? Or they're finished at a higher level with granite and shaker cabinets, etc. This comes with just underwriting a ton of deals. One, underwriting a ton of deals, and 2, pulling historical transactions, which is something your agent can help you with if you don't have MLS access. And then you start to develop a sense. So, when a deal hits the MLS that's listed at 175 a unit, what is that? 525K? Yeah, it's listed for 525. And you look at all the bedrooms or the bedroom count and the finishes, and it's like mediocre finishes, a lot of 1-bedroom units. And you're like, those deals usually trade for a 125 unit in my market, which would be, what is that? 375. Then you obviously can see that, hey, this is a deal where there's just this massive delta here, and it's just not going to be one that makes sense for me to pursue or even engage with the broker on. So that, I mean, that's a quick one, right? And that also follows suit for 5+ unit properties as well. Same thing, right? Now, obviously, we're valuing 5+ unit buildings based on cap rates and NOI. So it's going to be a little bit harder to take a price per unit approach, but fundamentally that still works, right? It's still most deals are going to trade within some parameters on a price per unit basis. Yeah, every once in a while, you're going to have an outlier on the high end and an outlier on the low end, where, the outlier on the high end might be big bedroom count, beautiful neighborhood, premium rents, and it's trading, at a significant premium to where all of the other trades are occurring. And then on the low end, same thing. Maybe you got a building with all these studios, tough area, low rents, trades for the below the bottom threshold considerably. But 80% of your deals are going to trade in some type of some type of range within a given market and within a given product type, right? In terms of you're looking at properties that are in the same class, kind of same market, general area, etc. So again, this is back of the napkin. This isn't all your underwriting, but when you look at all these historical deals and you see, okay, most deals trade for between 100 grand a unit to 130 a unit. Again, bottom end of that range, smaller units, lower rents, top end, bigger units, higher rents, or it's a little bit area dependent. You're going to start to get a sense of like, okay, when the broker takes out the deal that's 130 a unit for a bunch of studios that are renting at the low end of the rent range, that's very quick feedback that you can provide, or you can understand how to allocate your time and energy from an underwriting standpoint. That is really like most of our back of the napkin screening. If it passes the sniff check there, then we'll get into doing our yield on cost underwriting for the 5+ deals. I've done a ton of podcast episodes on this, but there's a reason, and it's because it's how we underwrite all of our deals. Yield on cost versus market cap rate. It's the most straightforward way to underwrite it. And again, I've talked about it, but the quick refresh for everyone. Purchase price plus projected renos. This is quick. You can do it on your iPhone calculator. 10-unit deal, $1 million. All right, we're paying 100 grand a unit. We think we're going to have 20 grand a unit in renos. All right, so we're into it for 200K, 1.2 million. We're going to leave closing costs out while we're doing our back of the napkin screening. We're going to bring those in when we do our underwriting. But again, if we're doing screening underwriting, let's just keep it simple. Purchase price, reno cost, projected reno cost. We're into it for 1.2. We think we think our stabilized NOI is going to be 100 grand. We're just taking whatever rents we think we're going to get for each unit, apply a simple expense ratio that makes sense in our market. Maybe that's 40%, maybe it's 35, maybe it's 45, whatever it is. So we're going to go ahead and take our gross rents multiplied by our expense ratio. What's left over, that's our NOI. So let's say it's $100,000 in projected NOI for this deal that we're into for 1.2. What is that? I'm doing it on my phone here. That's an 8.3% yield on cost. We want that number to be 150 basis points, 1.5% to 200 basis points, 2% over the market cap rate. So if the market cap rate in that market is 6.75, all right, cool. We got to go check this out. We got something here. We have a potential deal. That's really the easiest way to do it, and to do it a little bit more precisely for the 5+ unit deals. But that's really it. That's the high level approach from a screening standpoint. And then once deals start passing that sniff check, that's when you actually get into the more intensive underwriting. Question number 2 from Jeff. What is your favorite way to get into deals? And when you raise capital, is it debt or equity? So I'm going to quickly answer that question, but then talk a little bit more about how we think about debt versus equity. So when we raise capital from investors, it's always equity. And then we're going to source our debt from a lender. Whenever raising debt from our investor base, we're sourcing debt from lenders, whether it's banks, credit unions, bridge lenders, etc. And then we're raising capital from our partners and our investors who are investing as equity investors. They're partners in the deal. They have an equity interest in the deal. And there's multiple reasons for that. One, it's just much easier to build your business that way, right? Raising debt is an entirely different process. It's an entirely different investor profile. Our investors want to invest in equity, so that's why we do it. And it's much easier to go and just raise debt or source debt from lenders instead of trying to raise that debt in small chunks from a large number of smaller investors, which is how we raise our equity. So that's a bit outside of our model, and we just raised equity capital. Now, I do want to touch on this because I think this will be helpful for the listeners here, is when you are scaling or when you're looking to scale and you run out of your own resources, which is the exact position I found myself in right around 2020, right? Had been buying deals for 4 years, using a lot of debt, my own capital, levering up on all of these deals, right? Finding really, really compelling deals that lenders were comfortable giving me very high LTV loans on because I was buying them at a discount to market, and therefore their loan to current value was still within their risk parameters. Rolling my cash over, spreading it out amongst more and more deals. And then I realized this is a really stressful way to build a portfolio, and it's really, really hard to manage my cash. I want to scale. How do I do that, right? Do I use even more debt? Do I lever up even more? Do I borrow 95%, right? Or should I go out there and start raising capital from investors and or partnering with other people, right? Bringing in other people who are going to invest either as a partner or alongside me as an equity investor, or actually raising capital through like syndications from retail accredited investors, right? Regardless, do I want to bring in partners or investors, or do I want to just continue using more debt and spreading myself even more thin? And in hindsight, if I had gone the debt route, I probably would have fundamentally made more money, right? I would have earned higher returns on my own capital. That said, the market, making that decision, I made that decision before the market started running. So, that's hindsight's 2020 in a way. But for me, the big decision point was, what is a less stressful way to build my business? What is a less risky way to build my business? And those two things go hand in hand oftentimes. What makes my cash flow management significantly easier? And what do I want to do in the long term, right? Those were a lot of the questions I asked myself. I'll start with the last one. What I wanted to do in the long term was buy bigger deals and, go from buying 2 to 10 unit deals to buying 20 to 100 unit deals. And in order to do that, I was going to need to raise capital to buy those bigger deals, right? Even if I used a lot of debt, 90 LTV, like that's still too much money out of my own pocket to pursue those deals. So I knew I had to start building those relationships with investors early on some of the smaller deals at a smaller scale to continue planting those seeds to then grow the tree, so to speak, to one where I had a larger network of investors that I could then pull on to buy those bigger deals. So one, bringing in investors, even on the small side, for the deals that didn't necessarily make the most sense to raise capital for because the numbers were much smaller. And, raising 300 grand, 400 grand, 500 grand for small deals doesn't net you that much as the sponsor, but it does allow you to build relationships with the investors who are investing in those deals, which is important. Some of the other questions about cash flow forecasting, risk stress, it's much easier to raise capital for a deal in terms of you're raising everything that deal needs day one. So you're raising everything you need to close it, to fund the closing at closing, your down payment. You're also raising everything you need from a reserve standpoint. Right? You're raising everything for the renovations, everything for an operating reserve, maybe an interest reserve that your lender needs, and you're funding that. And then you're raising some contingency capital as well. All of that capital goes into an account for that specific LLC that everybody's investing in, and you pull on that capital to actually execute on the business plan. As a result, that makes it far easier to manage your cash for a specific deal because you're raising what you need up front to fund that deal most of the time. Now, there are some deal structures that people use. Maybe it's funds, maybe it's me and my partner are just going to invest enough to get it closed, and then we'll fund it as needed post closing. And maybe you have more of a specific relationship with one investor or one partner, something like that. But for the vast amount of deals where people raise money from investors to fund, you're raising the capital up front and you're deploying it over the life of the business plan. That is a far easier way to manage capital and manage your resources as an investor versus high LTV debt, putting down capital to get it closed, funding renovations out of pocket, and spreading your money amongst multiple different deals and multiple projects. So that was a big reason why we started raising money was, sure, I'm going to own less of this deal. I could probably make more on this because I really believe in the deal and I'm sourcing it direct to seller and I'm buying it at a discount. If I bought it at this discounted price with more debt and kept more of the equity myself and didn't give up the equity to partners or investors, but that became a much more stressful way to actually build the foundation of what I wanted to be like a real business and not just me like gunslinging buying deals, throwing stuff at the wall. Now that takes me to the last question from Christian. What's your end goal? Do you want to buy out partners, keep growing the way that you are, get into development, something else? And I think this is a good question because it's not something that I talk about on the podcast that much. I really don't talk about our specific business that much as it relates to like what we're actually trying to do. But this is a really good question. I think that I can answer this in such a way that provides value to the listener and helps to frame how investors make their decisions as well. So, right now, our business is a blend between two things. The majority of what we buy is funded with investor capital. We buy these small to mid-sized deals and really a select few very small markets in the Northeast. And that's what we do like today. That's our business right now. We buy anywhere from 125 to a couple hundred units a year. I mean, that's what we've done over the last 3 years on a consistent pace. We're not massively growing year over year in terms of like we bought 100 last year and then we're going to buy 300 this year. Next year, we want to buy 750 or whatever. And there's a couple of reasons for that. It's because the market's not going to give us that. We don't invest in markets that are large enough for us to pursue those types of deals. We manage everything in-house. We're vertically integrated. So our operational infrastructure has to grow in tandem, which is much more labor intensive than the, call it, investment business of finding deals and raising money. And those deals just aren't as compelling from a return standpoint, frankly. And it's obviously more competitive. So there's not many that trade in our market, but the ones that do trade to the 10th decimal point in what has now become a fairly competitive market in the greater Boston, Southern New Hampshire area. So as a result, we continue executing our direct to seller strategy and buying a lot of these 5 to 25 to 30 unit deals or portfolios of smaller properties from one seller. And that works, right? We raise capital to buy them. We can still raise between $3 and $7.5 million a year. I mean, that's kind of where we've raised money over the last few years. It allows us to buy $15 million worth of real estate every year, $20 million of real estate every year, depending on the deal size and who the partners are that are involved. And it keeps us busy, right? That's a business that continues to grow and continues to, satisfy the objectives of the folks who are in it, myself and then the team. The other piece of the business right now is I still buy a handful of deals myself every year where, we find a deal, I'm just funding it with company dollars or my dollars. And that's still a part of my personal objectives, is to grow my personal portfolio from an investment standpoint. Now, what does this lead to, right? What's the end game here? End game is to continue growing a portfolio of small to mid-sized properties in Southern New Hampshire while slightly increasing the number of what I'll define as larger 75 plus unit deals, which in our market's like $15 million plus in purchase price size. Like to continue increasing the amount of those deals we do year over year. Last year, we bought a 72 unit, which was great. My goal is that we could do one of, that was the biggest deal we did at the time. My goal is that we can continue buying one of those deals each year and then slowly increase the amount that we do so that we can incrementally go from buying 150 units a year to a couple hundred to 250, maybe 300 to 350, 400 plus. Now, this is linear growth, and many of the guru hype business guys online will say, you got to go bigger than that. You got to grow faster than that. You can grow exponentially. And while that is probably true, that does introduce a ton of operational risks within the business, which is something that I'm trying to avoid, both on the management side as well as just internally in the investment business side, right? Raising the capital, getting the K1s out on time, providing quality investor relations to all the investors who are participating in what we're doing, right? Sending out the monthly updates, all that stuff. So for me, that's become something that I've shied away from, and the business doesn't really need that, right? And my personal goal long term is to continue building my personal portfolio, which is truly the long term goal for me, right? The North Star in the real estate the North Star in the from a goal standpoint for me, real estate investing wise, is to own a sizable portfolio of cash flowing, moderately leveraged real estate that I personally own with no investors. Now, this is a 25 year down the line goal, right? This is like not what I'm trying to do in the very short term, although I'm going to continue working there or working towards that. But the Aligned Real Estate Partners business, I enjoy it so much because of the fact that we do find great deals and we do really execute well for our investors. And I take a lot of pride and joy in the fact that we actually earn our investors really compelling returns, especially over the last few years when so many of our investors are invested in other opportunities where they've just gotten smoked and their equity's gotten wiped out and it hasn't gone well at all. So for me, Over the next 5 to 10 years, it's to continue to slowly grow our portfolio of real estate in Southern New Hampshire while slowly increasing the average unit count of the deals that we buy. So we do less of the 5, 8s, and 10s and more of the 15s, 20s, and layer in more of those larger deals each year that pull our average unit count up, which downstream from that makes the capital raising process easier, makes investor relations easier, and makes operations much easier because we're condensing more of our deals into a fewer number of addresses and buildings, which I think is huge for us. So that's fundamentally the objective. Kind of the specific answer to that question is, no desire to get into development, at least right now. Maybe that changes in the future, but development and value add multifamily or buying existing multifamily are two completely separate businesses. Like they're just so different, right? The skill set required to be a great developer, especially if you're just taking raw land and bringing it through permitting, approvals, all of that, and then getting a shovel in the ground, actually getting something built, is a very, very different skill set than buying and operating existing multifamily. And I'm a huge believer in focus, both in your market, in terms of like the markets that you buy in and the product types that you buy in, the people that you work with, and narrowing your focus down so that you can become truly the expert and the most well-known person who's doing a specific thing in your sphere. And then you can slowly start to widen your aperture and widen your focus as you develop serious momentum, right? Maybe you layer in one more market, or you start layering in like another product type or something like that. I wouldn't say that we're at that place yet, even though we're doing a really high volume of deals in a smaller market, but I'm not ready to split that focus up quite yet. So for now, continue executing with what we've been doing, continue growing our capital base, and then slowly increase the number of deals we're doing, or I should say the average unit count of the deals we're doing, and the number of larger deals that we're doing, which each year maybe we're doing one deal that's 40 to 100 units in size, but the goal is to do a couple of those a year and to continue increasing our average unit count. So hopefully you found this episode helpful, and hopefully there were takeaways in here that you can apply to your business. And again, if you want to send in, or if you want to message me, even when I don't prompt it on my Instagram story as a, hey, send me some questions, I'm going to do a feedback episode. If you want me to touch on a topic in any of these solo episodes, I always encourage folks to shoot me a DM on Instagram at Multifamily Wealth, because I do take a lot of those questions and then I turn them into podcast episodes and turn them into kind of longer form content here. So if you have something that you'd like me to touch on, shoot me a message. But if not, please leave the podcast a rating and review, and I'll talk to you guys next week.